We are in Ramat HaSharon, Israel, and today with a special angel edition. And my angel founder turned angel today is Yoav Amit. Yoav, are you ready to give us some insights?
Yep, as much as I can.
Great. So let's start with Yoav. What type of startups are you investing in these days?
So actually my investments are really broad. I have both apps, mobile apps investment. I have a chip company investment. It's really about the people for me and less about the actual industry.
So no preferred industry. Did you have a preferred industry in the past, or you've always broadened it out?
No, I definitely had a preferred one. When we just started angel investing, mainly B2C or inbound marketing, because I thought that you can get a lot of insight from early numbers to give you a lot of information about the rest of how the future will hold. And today, after some education on my side, I've realized that more than often B2B companies which are based on actual work of people and less about marketing and the way the market reacts is a lot, I won't say easier, but has a much higher chances of success.
Got it. And then what's a typical or an average check size that you write these days?
So my check sizes range from the lowest amount that I gave, which was actually restricted by the company, not myself, was the $50,000. The highest amount is $200,000.
Okay, and then what do you expect then in return? Do you expect equity, and if so, how much? Do you get convertible notes? What type of return do you expect to get?
The point in which I invest is mostly pre-seed, so it's mostly based on a safe, the standard safe document. Never uncapped. If somebody comes with an uncapped safe, then that's not even negotiable. So that's basically it. A lot of times, at least twice I can remember, I joined an equity round, but led by a big time VC, and then you don't have much maneuverability. You just get the equity, the money you bring in brought you.
And then do you usually invest by yourself, or do you usually tag along with a group, or how does it work?
So we're a group of friends, all entrepreneurs turned investors after a successful startup. And we invest together, but we don't have a mutual fund or a mutual pool of cash. We just tag along one another. It's not mandatory. I could invest alone. I have one company I invested alone. There's companies my friends invested and I decided not to. So it's pretty fluid, but yeah, we bring each other along.
You're a founder turned angel investor. Tell me a little bit about the story of OpenRest, the company you founded. What was the timeline of it? What was the story behind it? And of course, the exit event, etc.
Okay. My startup process started not with OpenRest, but I just had too many friends doing startups and also too many friends having exits. I decided to leave the company I worked in as a head of software development, and just started playing around with startup ideas. The idea for an online ordering system is a stupid idea. We didn't come up with it by sitting around and saying, "Oh, this will be cool." We actually had a big restaurant in Israel come to us through a friend and offer to replace their current system. I've mostly worked with embedded software and really high-level system architect kind of products. And the option of moving to web development was, that'll be kind of cool to play around with. We went live in April 1st, 2011 with our first restaurant, and the numbers just boomed. We replaced an existing solution, and we immediately increased the restaurant's revenue.
What was the product about?
It was an online ordering system. Simply a website branded by the restaurant where you can order. There's tons of those. It wasn't an original idea. We just did it much better than the previous system they had. And people around Israel heard about it, heard that it does increase revenues, and pretty quickly using a distributor in Israel, we got to around 200, 300 restaurants in Israel. We completely dominated the market of white label online ordering system, not portals, but white label. We decided to try and duplicate that kind of solution worldwide, looking for distributors all around the world, starting with friends and then through offering on our website. We had distributors in California, Canada, Belgium, England, India. We had even an interest from Nigeria. We had US Virgin Islands. We had distributors around the world, but nothing really hopped. Nothing. If Israel was 200, 300 restaurants, the toppest distributor we had around the world was California with 20. We decided this isn't working. We had a salesperson who traveled the US, tried to sign up distributors. This wasn't working. We were completely bootstrapped. It's important to say. I'll touch it in a second. And we decided to completely change our go-to-market to inbound marketing. We put on a fake website saying, hey, do you want a restaurant app? At that point, we already had mobile apps for restaurants as well. And we saw that restaurants were starting to sign up. We completely changed our onboarding process to be self-service. And then restaurants really signed up, went through the process, paid, and we saw this was working. 5 months after we started, we already had a good number of restaurants per month signing. And between ourselves, we thought maybe this was a good time to start considering investments. Up until that point, we didn't want one, mostly because we didn't want anyone to tell us what to do, and we didn't want to owe anybody anything. We just like to do our thing.
So that's like 2 or 3 years after you started?
Yeah, 3 years. There was no really strategy behind not taking investment. It was just, hey, we enjoy not having to accommodate someone's wishes. So we were inbound marketing, 5 months in, restaurants going in, and one morning I just woke up and I saw that a restaurant signed in owned by Gyura Kaplan, the CEO of Wix. I called him, I was like, you don't have a restaurant? And he was like, yeah, I saw your software, it looks cool, let's talk. And about a month and a half later, we were acquired by Wix. It was a really quick acquisition because, again, we were 2 people, we had 2 employees at that point, but we know that if we were going to go to a very intensive acquisition, it'll take all of our attention, and the company will suffer. So on our first meeting with Avishai, the CEO of Wix, we told him, okay, let's start the process. You have a month to give us an SPA, not even a term sheet. A term sheet, you have a week, and you have a month to give us a contract that we can sign. And this was during September, during the holidays. And indeed, all time frames were met, and a month later we were acquired. 50% of the amount was given either time-based or at the moment of the acquisition, and 50% was earnout, was based on performance. 4 years later, both the time-based and the earnout were fully given, and we left Wix. And ever since then, actually, during the time in Wix, we used to meet with startups about 2, 3 times a week on Wix's rooftop, which is an amazing rooftop, to talk about startups, to give our recommendation. Once, twice a year, there was a startup that caught our eye and we invested. And right now, 2 years after I left Wix, I'm continuing to do this I won't say for fun, but as a profession, but as a hobby as well.
So the Wix acquisition and post work time there led you into the angel investing area?
Not really, because a few months, actually a year before we were acquired by Wix, I started angel investing in friends, $10,000 here and there. One of them was Accelerweb, which was sold to Limelight Networks. So, $10,000 what I could before the exit. I started also then. mainly focused on friends because that's the easiest way to due diligence. You just trust your friends.
Tell me about the moment of the exit. What was it like going through a life-changing event like an exit? I assume before that, and maybe I'm wrong, but tell me, I assume before that you weren't, let's call it like, it wasn't raining cash on you, so it was a life-changing event, right? What was it like?
Because the acquisition was actually 50% of the acquisition was earnout and another around 25% was retention. So, and out of the 25% that was given at the day of the acquisition, about 15%, I don't remember the exact number, was escrow, which means that it's kept in someone else's hand for a year and a half to make sure Wix isn't getting sued by anyone. So most of the cash was actually given in droplets, let's call it like that, throughout the 4 years. And a lot of our mindset was really how to aggressively meet our milestones. So there wasn't no resting period. There wasn't a period where I could tell myself, hey, I have tons of money now. I did buy a car with the initial money, a dream car of mine. And I also always wanted to travel to a big poker tournament in the Caribbean, so I also did that. Retrospectively, both the dream car, I could have bought a Miata, which is also an amazing car, and the trip to the Caribbean was like $1,000 or $2,000, something a high-tech person can afford. So both I was just waiting for nothing around. So I can't say that it really changed my life at the moment. 4 years later, doing nothing now and having the privilege of spending most of my time with my newborn daughter, which is already 2 years old, that I think is the true reward afterwards.
In your opinion, how important was to have a co-founder in the journey of OpenRest, and why?
I think that the real advantage of having a co-founder is actually the fact that you don't want to disappoint someone else. When it's your startup, when you're alone, especially during the early times, things can go astray and you're like, okay, I don't have the power for it. I don't really want to do this. This won't work and stuff like that. But the moment you're two people, and I think the correct amount of people is two people, because anything more than I think you get diluted too much, and anything less, we're just now talking about it. So I think the real advantage was the fact that you don't want to disappoint the other guy, and you just keep on pushing just so you won't be the one to say, hey, let's quit. And I think both of us had moments when we said, okay, this is a complete waste of time. Again, for the first 3 years, we didn't even take out salaries. I worked a day at Onavo, and Danny worked at Convert Media. We each had our different thing, which was also a good thing to have a day apart, since we also worked Friday and Saturday on the phone and stuff like that. But again, the main advantage, I think we both had points during the startup where if we could go into each other's mind, it'll be, let's quit, let's stop, this is taking too much, this isn't working. And the fact that each one of us didn't want to be the one to say quits, I think that helped just push along.
Thinking back, bootstrap, VS, maybe raising money for OpenRest, when you know everything right now that you do know, do you think you might have been better off if you've taken some investment money, or you're completely happy with the bootstrap way?
In our case, I think had we taken an investment, good chance that right now I'd be a developer at some company. The fact that we didn't take an investment allowed Wix to acquire us for an amount that isn't even high enough to be mentioned in the papers. And at the same time, we each had around 50%. So to our pockets, we cashed in more amount than people who raised round A's, round B's, and then sell for $100 million. Had we taken an investment, I think that OpenRest by itself could not have been valued too much. We probably needed to pivot and probably needed to pivot to something to compete with Wix on building website for restaurants and not just online ordering system. And I'm not sure we would have been successful. So Danny's stubbornness on not to take an investment, I was more pro investment, but Danny's stubbornness not to take an investment pretty much helped us achieve the goal of selling to Wix.
Danny's your co-founder.
Yeah.
Startups or first-time founders just starting out their startup, when do you think they should and how should they approach an angel investing, and when should they maybe directly go into a VC? Give us some guidelines about who to approach and when.
So it's mainly about the level of product market fit you've validated. The earlier you have where you don't really have a product market fit, you might have just an idea, just some slides. That's when you mostly want to find people that'll gamble, that'll take larger risks. And today, mostly the people who will take larger risks are angel investors, and at some point, less professional angel investors. The ones that won't tell you, okay, I want you to run a campaign, I want you to give me 20 companies who have signed an LOI and stuff like that. People who really gamble on the idea. Now, having said that, I'm mainly concerning myself with first-time entrepreneurs. Second time, third time, I constantly hear about people who raised enormous amount of capital just from an idea, even without slides. But first-time investors, entrepreneurs who less have some credibility to their name, should aim to get some kind of initial product market fit and approach angel investors. Now, not all angel investors are the same in terms of not only what you get at the moment of investments, but also down the road. Getting money from, Peter Thiel will give you much higher chances of raising round A, round B than getting funds from Yoav Amit or from any other no-name angel investor. Sometimes you don't have the privilege of choosing, but it's important to note that when looking for angel investors, you need to think about what kind of tag, what does it say to your company to have this angel investor investing in your company. I had friends who had to buy out their angel investors down the road because either they were an obstacle or their name was an obstacle. I had investments myself, which I declined on taking, looking at the other investors inside the company. Just because I knew that now one of the things that have changed during my angel investment period is that now I'm more involved. In the beginning, it was just take my money and I don't want to be involved, but having invested in some companies and knowing that they took some wrong paths, which I could stop if I was more involved. And today, one of my conditions is that I'm involved. And knowing that if there's a different angel investor who I won't say disrespect, but who I don't know or don't vouch for their opinion, and having to constantly not say fight, but constantly debate ideas and processes with someone I don't respect, it's not worth the hassle. So having a good name angel investor is important, but of course it's a privilege. Not everybody can have it. So before you have a good product market fit, mostly angels. Once you have a sign of product market fit, which could be in a B2B world, a few companies who have actually signed a contract saying that they're about to pay you in March $10,000 a month, and having you promise them that the product is already ready, here's screenshots, and now you have like 6 months to push it. Or in the world of B2C, having a fake website and seeing that traffic is coming in. At the moment you have an initial product market fit, it's a good time to go to either micro VCs or even larger VCs if the market allows it. A lot of VCs like to invest early stage for the ability to actually invest later stage. They don't care about giving you now $1.5 million to gamble with, knowing that they'll be the first to invest in a round A with $20 million or something like that. So a lot of VCs do like to invest early stage just to have the option, and if you have a good product market fit validation, it's a good time to go there.
Okay, so we covered angels and VCs, and where do accelerators then fit in?
My opinion on accelerators is not good. I don't like accelerators. I think people are going to hate me now. I think accelerators are made by people who can't be entrepreneurs, who want to be part of the ecosystem. I've rarely heard of good accelerators or accelerators that have actually brought value to companies. I've rarely heard of companies who have sold after accelerators. All of this I'm putting Y Combinator aside, which is of course an amazing accelerator. That's who you want to be with. But again, Y Combinator, let's talk about their founding team and their management team compared to some kind of accelerator in Israel. So for me personally, and this is my personal opinion, a startup which has been to an accelerator, to me, is actually a bad signal for investing. When I invest, I gather signals, positive signals and bad signals and negative signals. And accelerators, if it's not YC, then it's for me negative. It means that the founders have not 100% devoted their time to creating value, but played some kind of a game with the accelerator.
As an angel investor, what type of return do you expect on a successful exit?
I think that if someone's going into an angel investment job expecting to get life-changing money, they'll be really disappointed and eventually lose all their money. I don't think that angel investing is something that is easily positive ROI. I think that compared to less risky paths, such as even the stock market, buying some kind of ETF, I think it's on par. The chances of falling on a company that'll be unicorn or give you times 10 the amount you invested is really difficult. So I don't do it to get life-changing money. I won't 10 times my net worth using angel investment. I do it mostly for the fun of joining startups in their process as a mentor, as an advisor, as an investor, all at once by actually investing and putting my time in. And that's the real reason I do it. I'm not doing it for life-changing money. If in 10 years from now I look back and see that I doubled my net worth using angel investments, I'll be really happy. And if you look at the past 10 years, double your net worth, that's about what you get at the stock market.
What is a investment that you regret not making?
So there are two I can think of. One is Next Silicon, which is a chip company, which I invested in round A. Elad Raz, the CEO, came to us at the pre-seed stage, and we decided not to invest. And that I regret deeply. The other one, I actually don't remember if it was really an investment opportunity, but I think I could have leveraged it to one. The founders of Sneak came to us to talk about their idea at the ideation stage, even a bit later. And I think I could have joined the round. And if I remember correctly, their last investment was at $1 billion valuation. Oh, wow. So so that's definitely an investment I regret. And another investment I have to say I regret is having been 2 years into Wix, my wife asked that we put like $100,000 or so into Shopify. It's not really an angel investment, but actually stock. And I told her you can't invest, you can't win if you invest in specific stocks. You need to invest in ETFs. And I think Shopify times 50, what's their worth back then.
So you owe your wife.
Yeah, like $5 million. Yeah.
What's the most memorable pitch that you remember from? It doesn't necessarily mean you invested, but what's the most memorable pitch you've heard?
So actually, my most memorable moment is pre-pitch. We met a guy at the Wix's entrance. Going upstairs, you need to take an elevator and then a few stairs. And we started, the small talks before. And Danny told him, he said, thank you for your time. I hope I'm not wasting it. And Danny told him, as long as you're not a restaurant bot, it's all good. And it was like dead silent. And it was like, you're a restaurant bot, right? I was like, yeah. Because then it was really popular to create Facebook bots for restaurant where you order for your Facebook Messenger. And I remember the awkward silence going there. So actually, I don't remember that many pitches, but this was one I remember.
What were some successful investments, if you have, since angel investment is a very risky path, so not always do you even have a success, but if you remember some successes, can you share those with us?
So Next Silicon is one of them, because they had a good round A, which I joined, and they're creating great value and growing, which is excellent. Having, let's say like that, investments which were liquidized, I think that currently there's only Accelerators, which was sold to Limelight, but that was pre the high stakes, more $10,000. Right now, most of my investments are still running horses, still in the track. I had one company which was more of an investment for the do-good, to help home pets, to increase adoptions in home pets, which unfortunately was closed. So that's one investment, around $50,000, which went bankrupt. Other than that, I believe all my other investments are still running the track.
You still have chips in the game.
Yeah, exactly. And I think most of them are good. I'm running for them all in my head. I think most of them are good. Yeah.
Are you waiting for for the big IPO, or will you take a secondary round later down the road?
I'll think about it when the options are on the table. Again, it'll be really hard for me to get life-changing money from investments. So the big ones that I have in my mind, I'll probably want to run the entire race with, put it all in. The smaller one, any kind of money back will be nice. And again, since newspaper never write the amount and never write if the investor even earned money or lost money, then any articles that has my name is a cool thing to hang on the wall.
I know you love playing poker, and I've read a couple of times you have a lot of similarities you think exist between founding a startup or the startup journey and playing poker. Can you share those thoughts with us?
Yeah, I don't think it's coincidence that most of my friends who sold companies play poker semi-professional. Yair Weinberger, Ophir Ehrlich, Daniel, my partner, Sal Viv, to name a few who I constantly play with. I think the fact that you need to constantly make decisions without having full information and assessing risk and assessing reward, constantly being put in that situation, gathering as much information you have around to make the decision in a non-full information scenario really helps in the entrepreneur process. It's also a lot about, Because eventually a lot about entrepreneuring is just making a decision. You don't really have to have it the most optimal decision, but mostly just making a decision and standing behind it, and having the correct thought process to bring you to that decision. So I think poker really puts it into perspective, gives you a lot of situations to practice with it. So I think that's basically a good way to practice.
Would it work the other way around, do you think? Poker players would become good entrepreneurs?
So I've heard about a lot of top poker players worldwide, the toppest of the toppest, who became investors. Again, when you're a good poker player, you don't go to be an entrepreneur because the money's already flowing in. But I heard about top making investments, and I'm not sure I approve of their investment strategies. So I don't know. I'll just leave it at I don't know.
Having been both a founder and an investor, what do you think is the main difference between the two? They're part of the same ecosystem. They are going together on a journey which is joined together, but what are the main differences between them?
I think the roller coaster. As an investor, there's some roller coaster. I mean, a company calls you and tells you that they're about to raise a higher round. You're like, yippee. And the company calls you and says that their top customer just fell through, and you're like a bit down. But it doesn't, you don't feel it as deep as the entrepreneur whose life is in the game. For you, it's just another investment track. I have both real estate, I have stock market, and I have startup investment. So it's just another investment. If tomorrow the company closes, it's not my one shot. It's not my single chance. I can try it again. I could invest in another company. Okay, so I lost $100,000. It's a lot of money, but I'll survive. In terms of being an entrepreneur, I think for a lot of entrepreneurs, it's a one-shot game. If you lose it, you lost all your savings, and now you need to go back into the standard employment process, and your significant other, husband or wife, are now pressuring because you have 2 kids and you need to put food on the table and stuff like that. So I think for a lot of entrepreneurs, it's a one-shot game, and the roller coaster is, because of that, the roller coaster is more aggressive. And I think that's the main difference, the amount of emotions you have in it.
Do you sometimes miss being a founder, or absolutely not?
Absolutely not.
Why is that?
I like my life right now. I like the fact that I have time to be with my kid. I like the fact that I have time to practice my hobbies. I like the fact that I'm not playing any political game of I don't know, moving chess pieces around to make something work. I like the relaxed time. I'm financially secure, so I don't have to worry about that. And I knowing myself, that if I start something new, I'll be completely devoted to it, and I'll start working till midnight, till 1 a.m., and I'll start missing sleep because of a letter some customer sent, and I know I'll be fully devoted, and I enjoy having a more relaxed life right now.
And do you see yourself having another inning in you in the future? Do you see yourself ever becoming a founder again, or do you think those days are long gone?
So I'm 38. I still have hopefully a lot of time to live. I'll say it like this. I'll go into a startups in 2 circumstances. One, that it's some kind of a market that I really, really love and really have a challenge in involving. One of my hobbies, the way that they scored competition is with paper and sheet, with a sheet of paper and pen. And I decided to spend a month to completely write an electronic scoring system. and it was really, and a month later, Israel uses it completely. I have customers in Italy, I have customers in Greece. It's not a startup. It's a nice little hobby I created, and somebody is putting money in, paying for it. If it grows to the fact that it's ROI positive in terms of the marketing, that'll be great. It's a industry I love. I love the hobby I'm in. I love the opportunity this will give me to travel to, let's say, the World Championships, which I think that I won't be able to do as a competitor. So if this software goes into there and I'll be able to go there as a supporting engineer, it'll be great. So that's one circumstance. I'll do a startup or a venture, let's call it like that. The other one is if I do find myself in a position to create a $1 billion company or a $10 billion company. I don't need the smaller size exits. It'll be fun, it'll be nice, but it won't change my life. A much bigger exit that might be life-changing enough for me to decide to give up, let's say, 10 years of my life to do. And even that, I'm not sure. I'm not sure what I would do different if I had $100 million in my bank.
So if it's a car money, you're not in. But if it's yachts and mansions in Beverly Hills, you're fine.
So not even that. The only thing I'll say it like this: 2 years ago, even that I would say no. And then I had the opportunity to go to a competition in Russia on a private plane. And then during the private plane flight, I was like, okay, I might enjoy a private plane. And okay, maybe, but that's it. Mansions, you can see my house, it's not a mansion. It's not something I'm looking for. Cars, I have 2 sports cars, which I love more, which I adore. I won't buy a Ferrari in Israel. I won't buy a Lamborghini in Israel. I respect all that, bought it, but too much money goes to taxes and stuff like that. My dream car is a Koenigsegg CCX, which you can't even import to Israel. So no, I don't need the money for that.
As an angel investor, what KPIs are important to you when you're examining a potential investment, and why?
So any KPI which directly shows product market fit of some sort. It really depends when I first meet a company, I decide in my head if the right go-to-market as a feeling, as an intuition, is having salespeople knocking on doors, cold calling, and stuff like that, or more of an inbound traffic kind of a startup, which has a website, buys traffic for Google and Facebook, and earns from that. Of course, there could be the hybrid, which is getting your traffic through Google Ads and stuff like that, and then having salespeople calling. But the main question for me is, how do you get your initial customers? Then the next step is, I think, is the go-to-market justified by the amount of money you can ask for this solution? If you need to have salespeople knocking on doors and your solution is sold for $9.99 and $9.99 and $9.99 per month, then it's not cost effective. You won't be able to return the amount of cash you go through with salespeople. So I make sure that in my head, as general numbers, you can't really be sure, but just as a general numbers, does that fit will that work? Having decided on which go-to-market will work, then the real question is, how do you validate the go-to-market? So if it's a sales people kind of a go-to-market, I really want to make sure that the entrepreneur talk to like 50 executives who can sign a paycheck, who told them, yes, this pain hurts. I would really want a solution like this, like this, like this. And then the entrepreneur says, that's exactly what we want to do. Not coming with the idea and then having the other side say yes or no, but having the other side tell about the pain. If they have like 50 people who have already expressed interest, and out of it probably got a design partner or 2 extra credit if the design partner is willing to pay for the beta phase. Again, a lot earlier than having developed the software, just as validation. Then for me, it's like a big check mark saying, okay, there's initial product market fit validation. On a risk reward kind of a scale, the risk matches. In a more of a B2C inbound traffic scenario, my constant saying is build a fake website on Wix, commercial, or any of Wix's competitors, faking the actual process you want a customer to go through. The more you fake, the less risk the investor will take, and drive traffic into that website. My wife wanted to create a product, a physical product. She put on a website selling the product with fake images, drove traffic into that website. People would go through a complete process of picking the item, putting in the address, and putting in credit card information. And after they put in the credit card information, the site will constantly pop up a message. We couldn't clear your credit card. We apologize. Please come back later. And that's a good validation because she saw how much traffic would cost her. What's her return on investment on that traffic? Is it positive? And could make an informed decision if to go through the process of manufacturing this product. Now, there's still a lot of risk because first, the amount of money of traffic you brought is not high and the amount could be capped at some point. And the manufacturing, in her case, is difficult. And software case, it's a lot easier. But having that information mitigates the risks to the point of, okay, I can invest there. But I have to say that investment is actually it's actually not what's important. As I said before entrepreneurs, most of them have one shot. And having this validation process is important to them tenfold as much as it's important to me because it's their time. If they start manufacturing or developing the software, most of them using outsourced resources, they'll spend a lot of time, a lot of money not validating the most important thing. The product is not the important thing. The product market fit is important. So as much as it mitigates my risk enough for me to want to invest, I think for entrepreneurs, it should be their main concern to mitigate their risk in their time as the main resource. So I think it co-aligns with what an entrepreneur should do anyhow, and not as a sidetrack just to get me to invest.
How involved are you today with your portfolio companies?
So initially, my initial investments were really just take my money and I don't want to hear from you. And again, a lot of them made mistakes I could easily have helped. Today, my condition is to be either myself deeply involved or someone I respect more than I respect myself deeply involved. If one of my friends or myself have at least a weekly chat with the founders, then that's a main condition. Having said that, I think that once you get to know us, you won't want a weekly discussion, you want a daily discussion. Two of my friends have invested in a startup. We started with like a weekly meeting and pretty quickly it became like twice a day, 2 hours conversation. Wow. And deeply involving also in a lot of processes the company needs that they have expertise that the founder still doesn't. And really walking around with the founder through the difficult part and training them. I think it's more interesting if we talk about investment not as something money oriented, as I don't believe it will change my capital gain, my capital that much. I think it's just more fun and to walk that path with a good entrepreneur.
Thinking about yourself, not just any other angel, but yourself, when should a founder and how should they approach you? Is it cold emails, cold calling, banging the house door, How should they approach you and when?
So the best way is through connections. I won't say it isn't. If someone I know tells me, "Hey, can you please talk to this guy or hear their pitch?" There's like a 99% chance I'll agree. My mom called me the other day. A son of my friend needs some help. Can you please talk to them? I was like, yeah, definitely. So it won't be politically correct to say it, but yeah, connections is the best way. The second way is any cold method. The most popular ones are Facebook Messenger or email. I have to say, but even then, you need to put some thought into it. I had people just send me an email saying, "I have an investment opportunity. Please call me to hear more." And no, I'm not going to call you. I have people even saying, giving me any kind of putting things into my to-do list won't get it done. If you send me an email and say, "I have an investment idea in this market. Would you like to see a deck?" Lower chances that I'll send an answer yes. I get tons of email. I don't have the time to respond to all of them. The more information you can give me in the initial stage, the better. Just a cold email with a good deck and just a link to a website should do the trick. A lot of times, by the way, I answer in different Facebook groups questions, and from those questions, I look at the company. I never answer a question before I investigate about the company who's asking. A lot of people just answer without even looking at the profile. A lot of people answer in the masculine tense to a female questionnaire without even looking at the profile at the minimum to say it's a female. She's a female. But I do my due diligence. I go into the process of reading about the company and then answering the question. And a lot of time from that, I get to great companies. There's a company called ProveSource who asked a question in one of the forums, and I went into their website, I read about them, and I pretty much begged them to take my money. And they're still refusing, actually. They're completely bootstrapped. They don't want external funds. So just getting into my radar with a good company is a good way.
And then what's the absolute guaranteed way of not getting your feedback? I mean, what's the don't do this?
Putting aside stupid questions or stupid emails, any kind of deck with a grammar mistake or a spelling mistake, I know it's being, I don't know how to call it, but in my view, if you haven't got the professionalism of spell checking, even asking someone, paying 50 shekels for an English speaker to go over your deck, or even a Hebrew speaker at some cases, to me it's a no-go. Most chances is I won't even respond to your email with the reason I said no. Any kind of mistakes in the sense that you could check for a second, for me it's a no-go. Any kind of a feeling of a copy-paste or even just a copy-paste for an initial line, I won't respect. If you haven't put the time and respect in me to send me an email knowing who I am, I won't put in the time and respect for you to respond and tell you why I think this, why I think not. So that's definitely no way to get my response. Any usage of finder fees based connectors or people, that's just a no-go for me. If I ever hear anybody reaching me using some kind of a finder fee, for me that channel would just be closed at that moment. I know a lot of VCs, one that I really respect, that during the due diligence phase you even have to sign in that nobody's getting anything from this investment. So I really vouch for that.
For founders of SaaS companies out there today, let's narrow it down for B2B SaaS. There's a lot of debate about if they want to sell their companies, what valuation should they ask? What's your kind of formula for founders to think about what type of amount they might be getting from a potential sale of their company? What's a realistic multiple for a SaaS B2B company these days?
I think that looking at a lot of exits throughout the years of SaaS B2B, I think you should be, the real aim, you personally want to win the game. You personally want to play it once. You want to have an exit that'll give you an amount in your pocket that you won't have to do the game again. You can be settled for life. If you want to, you can do it, but you don't have to. And I think that a lot of things that founders do early on actually will lower the chances of that happening. For example, having 4 founders. For example, getting money really, really early on for 50% of the company. Already you shot yourself down like having 4 founders. So I think as long as you don't do any mistakes that will cost you in the future money from any sale, you should expect a fair life-changing money, but don't expect to buy mansions and planes and stuff like that.
But should they go for, a lot of founders have unrealistic expectations about the multiples because a lot of, it's called hot B2B SaaS companies get valuations in the 20x revenues, etc. But when you get to the actual selling process, so if you have expectations of getting 20x your ARR, you're probably going to be disappointed hardly. What's, in your experience, what's a realistic multiple today?
So I don't think that I don't think that's the right way to think about it. Eventually, I believe in market powers. The multiple is a result of being standard, like everyone. Everyone sells with a multiple of 5. Everybody sells with a multiple of 10. You don't want to be a multiple. You want to be special. You want people to buy you at a multiple of 2,000. And eventually, it's about the value you bring and your negotiation skills. When we sold, the amount that we told Avishai we want was, I think, 8 times the amount, or actually 4 times the amount we would actually agree to sell for. And eventually, and it was really steep. There was no chance he'd pay that amount. And the thing is that if you're interested, if you're interesting, the other side won't tell you, whoa, you're crazy, let's hang up the phone right now. The other side will counter offer, or as Avishai told us, guys, this is way too high, but we'll solve it. Let's go through the process and we'll solve it. And I think eventually, looking at multiples and stuff like that, it's not the way I would view it. I would view as a strategy, I would get the maximum amount I could. For example, having 2 companies bid for you, it doesn't matter the multiple. 2 companies will bid for you. Oracle and Amazon will bid for you. You'll get extremely nice multiples. A company I helped with right now could only be sold to Wix. And it doesn't matter their ARR at that point. It's like, okay, you can only sell to us. This is the amount. It's a hard amount. So there's a lot of things you can do to increase the value. I have friends who started their negotiations with the other side offering X and ending up at 4x just because they did the negotiations correctly. So looking at the multiples, looking at things like that, I think it's not the right thing to do. Look at the amounts just to put a focus. I think looking back, I think we were at about 50 times multiple in our sell. I don't even remember our ARR. I think I'm even under, 200 multiple, the amount that we were sold for our ARR. A good way, Danny once described it for me. a good way to look at it is there's a minimum amount that you are willing to accept to start your company with. And there's a maximum amount the other side will accept to buy your product with. If there's an overlap between them, then where the amount will fall will be on your negotiation skills and on which side has more information to play with to put the amount of the sale. But eventually the sale will happen if there is an overlap. If there isn't an overlap, then the sale won't happen no matter what. And the trick in negotiations is finding out the other side's limit and playing around that. And the other side's limit really doesn't have to do with multiple. Amazon will buy a company not because, not an amount of 50 multiples, it's because Amazon looks at the company and says, I can increase my shareholder value by 20% using this technology. So the amount I'm willing to pay with it is 20% my market cap. And then the game, it's not a game of multiples, it's a game of negotiation and market trends.
What, in your opinion, are the hot trends in terms of startup for 2021 or the end of, we're nearing the end of 2020, so for 2021, is it still like AI and machine learning like it was in the past year? Is it something else? Is e-commerce coming back real strong because of COVID? What are your hot trends?
So I think COVID has changed the game drastically. Anything that has to do with two things, with hospital, which is hospital at home, and working from home has a massive trend right now. Really popular, really need. Anything that has anything to do with alternatives to traveling is really hot right now. Not only traveling abroad, but actually traveling in your area. Anything, for example, meeting experts from afar and stuff like that. AI, of course, always. AI in the COVID sense, clearly. I mean, I think Ellen Shochat just published about a startup which is working about identifying COVID positivity by the sound of your voice. So anything that has this seriously has a trend. AI, of course. Me personally, in terms of e-com, I just don't get it. I would think that Amazon won the game, but then you have Shopify, which is just growing and growing and growing, and any sort of add-on to Shopify, which is not just for Shopify, but generally Yotko, for example, which is growing. I just don't get it, but apparently it's a trend that's just growing and growing and growing. So these are the main things. I think you hear less now about cryptocurrency, which you heard a lot in the past. You hear less about, in my expertise, restaurants-related startups, which I've really lowered. What you do get is a lot of marketplaces. As an investor, stores, the easiest company people start is marketplaces, and it's just full of, sorry for the expression, crap, that it's really hard to find the Airbnbs from inside all the marketplaces and stuff like that. So for example, if somebody comes with a marketplace, initially I'm like, okay,
turned off.
Yeah. So I think mostly I will look more interestingly at hospital and working from far startups that really change. AR, VR, of course. I personally never really got connected to VR. I don't like it. I don't think it's the future. I think AR is the future. So anything that has to do with AR, I'm always happy to hear.
What are your golden tips or tip for first-time founders starting out just now? What, in your opinion, is like the most important tip you can give them?
So I think the most important tip is that there is a playbook. There is a playbook on how to do things right. It's not luck. It's not, there are of course strokes of luck, but it's playing by a playbook and doing it right. Now, there are a lot of people in the ecosystem who just want to play in the ecosystem, who wants to have the title mentor, who want to have the title investor, or even want to have the title entrepreneurs. There are a lot of entrepreneurs who just do it for the title. Hey, I'm an entrepreneur. Look at me. I'm meeting people. I'm talking about my startup. And as an entrepreneur, first for yourself, make sure every day you generate value and don't waste your time. You're not doing it to play a game. You're doing it because this is what you want to do and you want to do it right. And just don't play the game. Don't create a business card just to give it around saying you're the founder, you're the CEO, you're the CTO, and games like that. Danny and I didn't have titles up until our fourth year, which I think we built a website and we decided we have to have titles. And even then we invented titles just so we won't have to say who's the CEO and who's the CTO. So don't play the game to play the game. Play the game to win it and do that. As for the other side, when you're approached with investors, mentors, accelerators, and stuff like that, the other side, there are a lot of people who just want to play the game for the title. So never take advice from someone who isn't willing to put money where their advice is. Mentors who come and tell you I want 2% equity just for mentoring or as an advisor board, just throw them off the stairs, down the stairs. Trust only people who have been there, who have succeeded, who have done it themselves. A lot of people will give you shit advice. I've been to an accelerator where I mentored a company. Yes, I also been to an accelerator as a mentor. I don't know why. Where I mentored someone, and one of the company who funded the accelerator as a perk for their employees sent them to mentor. And opposing to me, there was a mentor who had no experience, no expertise, and was arguing about strategies with me. Now, respect is due to anyone. You don't have to succeed to be smart. But in this case, I mean, don't take advice from people who haven't been there, who's not willing to put money where their mouth is, and have the title. Be really, really, really sensitive about your cap table. Your cap table is one of the most important things you have. Our cap table remained completely clean up until the last second, basically. A lot of people wanted to help out for percentages. We had top tier attorneys where we paid out of our pocket on deferred payment just not to give them equity. Make sure you hold your equity. And again, I think the most important tip I can give is as early on as possible. The industry, as much as it is filled with fake people, it's also filled with a lot of people who actually want to help, who have been there. A lot of founders who have sold their companies or are managing a $1 billion company really want to help other founders. So as quickly as possible, find someone like that to help you to be your mentor, but a real mentor with real expertise, and join the process with you. It'll really save you making a lot of mistakes and eventually getting to know the playbook.
In retrospective, knowing everything you know now, do you think you've sold OpenRest too soon, or would you have done anything different, or you're completely happy with the way it went?
So first thing I would do different is in 2011, I would buy Bitcoin and then not do OpenRest or not do anything with my life. And I knew Bitcoin there. I actually bought a few $100s of it, but would have bought more. Have I done anything different? No, I'm pretty happy with where I am. I'm pretty happy reaching it. I think OpenRest was sold overpriced. I'm sorry to say that to Avishai, but I think actually I'm completely wrong. Wix just released their new reports, and Wix restaurants, the the next name for OpenRest, is generating tons of revenues for them.
So it's a win-win.
It's a win-win, and actually I constantly was thinking that they overpriced it, and now I'm actually thinking they're underpriced it, but I think at that time we actually got the maximum we could out of the acquisition. In terms of everything, the actual contract, having top-tier attorneys working on it, I think we did everything good, and I think we did as good as we could do.
What lies in the future for you? Will we ever see you as a VC? Will you go into real estate entrepreneurism? What do you think lies in the future for you?
I don't like the VC game. I'm bad at the VC game. Actually, it's less that I don't like, I'm bad at it. I don't do mingling good. I don't do connections good. I don't enjoy small talks as much as a VC should. So I think I would be bad as a VC. I think I would be seriously terrible VC. So I don't think that's the path ahead of me right now. I'm enjoying it, just practicing my hobbies and spending time with my family, and also trying as much as I can to give my wife some clean environment from which she could start her own startup and find fulfillment with herself. Because I feel that I'm really fulfilled in terms of professional with what I could do, and I really would like her to reach that point as well. And then a lot of traveling. In terms of capital, again, I don't think that, I think I've earned enough capital to be assured for my entire life and my life of my kids. So I think I'll just keep on enjoying my life. And if a very special opportunity knocks on the door to do something, a new startup or something, I'm not completely saying no. It just has to be something really special. My wife really wants me to travel. She wanted me to travel a lot more for poker. She really wanted me to do it more professional than I do it right now. And then COVID hit, so I couldn't. I had a trip to EPT Prague, which I did quite well, and that's it. So that's on hold, and most of our lives are currently on hold until COVID passes, and then we can rethink our life goals.
Well, Yoav, thank you very much for being our guest today. The journey you've had, OpenRest, is an inspiring story. It seemed like taking a very unique approach to angel investing and life in general. So again, thank you very much, and wishing you lots of luck.
Thank you.